What is asset liability management? Asset liability management, ALM, involves taking decisions and actions regarding assets and liabilities in an integrated manner in order to manage the business of the entity and meet the organization's financial objectives. The traditional application of ALM primarily dealt with managing risks associated with interest rate changes. But today, ALM has a much wider focus encompassing equity risk, liquidity risk, legal risk, currency risk, and sovereign or country risk. The traditional asset liability management tools matched duration and convexity on a weighted average basis. We will look primarily at interest rate risk, in particular interest rate mismatch risk and liquidity risk. Interest rate risk is a risk to earnings and capital arising from changes in the interest rates. There are four primary sources of interest rate risk. 1. Repricing or maturity mismatch risk. Risk arising from timing difference in the maturity and the repricing of assets, liability, and off-balance sheet items. 2. Yield curve risk. Risk arising from unanticipated shifts in the yield curve, indicating a change in the relationship between interest rate of different maturities relating to the same market. 3. Basis risk. Risk arising from the imperfect correlation between earned and paid rates on instruments having similar maturities and repricing characteristics. This imperfect correlation results in unexpected changes in cash flows and earning spread. 4. Option risk. Risk arising from the seller or holder of an asset, liability, or off-balance sheet item, having the right to alter the level and timing of its cash flow when interest rates change. Liquidity risk is the risk of potential loss to an entity due to the non-availability or insufficient of liquidity. This could mean that the entity fails to meet its financial commitments and obligations because of its inability to convert assets into cash or because it cannot obtain enough funds at a reasonable cost. Thank you for watching.